Now, let's just go across to the IndusInd Bank management speaking on the fourth quarter numbers before we start the show.
They declared results separately. Bharat declared results yesterday. We are declaring today. It's for no other reason except that 30th May is the 60-day deadline that we have to adhere to. And we're not sort of sure when that final order will be passed. So it's got nothing to do with the intent of the final outcome, and the merger is absolutely on track at all. So Bharat, in fact, disclosed their results yesterday, and I think in terms of IndusInd and all, they showed some good set of results that came out, which are in line with market expectations. So I think that's the major issue. I will now take you through the broad headline numbers. I think the underlyings for IndusInd Bank for the quarter remained very strong. See, underlying in terms of, top line growth, I think it's the first time in several quarters now that deposit growth has actually matched loan growth, and both have grown at around 29%. And this loan growth is also very well spread out. In that sense, it's pretty secular. So we are seeing that corporate grew by just over 20%. The retail grew by 27%. Vehicle finance grew by 26%. And vehicle finance grew by 6% quarter on quarter. So a 29% growth in the loan book, accompanied by a similar 29% growth in a deposit book as well, in which CASA growth was 26%. So pretty strong set of numbers. So the underlying, as I emphasize, remains pretty strong and pretty well distributed. The other one, of course, is fee growth. Fee growth came in at 29%, in which the core fee growth, which we always report every quarter, came up at 27%. And we'll show you the breakup of the way the fee is constructed, because there is also speculation in the market on the way we make our fee, although we've been disclosing this for the last 11 years. So strong balance sheet growth, strong fee growth. Then we come to the treatment of this one exposure that we have talked about for 2 quarters, which is an exposure to an infrastructure company, where we have already disclosed what our exposures are. And in line with our stated objective and our statement that we will take care of this particular exposure in terms of provisioning by Q4, that means before the end of the year. We have followed that intent through, and we have made a very strong and aggressive provisioning on account of that particular exposure. So if you recollect that we had made provisions for this exposure in Q2, we had also made provisions for exposures in Q3. But Q2 and 3, this exposure was not denominated as an NPA. In Q4, in line with the NCLTA's decision, this was classified as NPA, and therefore specific provisions were made. So just to give an idea on the extent of the provisioning that we have done, the total provisioning that we have done is 1,650 crores, plus another 153 crores for interest. Actually, therefore, the total provision or the total impact is 1,803 crores. So we reversed interest accrued on this exposure for 2 quarters, which amounted to 153 crores. And I think that clarification was needed because this 153 crores comes out of net interest income, and therefore it has an implication for net interest margin. So it's not everything below the line, it's not everything is below the operating profit. There's 153 crores also above the operating profit, which also impacts this thing. In terms of the extent of provisioning, we have taken a 70% provisioning on the holdco exposure and a 25% provisioning on the exposure to the operating companies, which are the SPVs. We have good reason to believe that this extent of provisioning is sufficient, and there has been a rationale behind the computation of this provisioning, because people also say, why don't you provide 100% and all, and those sort of things. but we have a very good idea of the total assets that lie in the holding company. We have written down the value of those assets to come to a realizable value, and on the basis of that, we have extrapolated the amount of provisioning that we would need for the holding company. As far as the operating company is concerned, where the exposure is about 1,000 crores. As per IRAC norms, you needed to provide 15%, but we have provided 25%. We have good reason to believe, and there are indications in the market that there could be a 90 to 100% recovery on this particular exposure. So we are quite confident about the sufficiency of these exposures, and we have followed our statement that we would want to leave this particular exposure to this particular group behind us in Q4. And I will now show you some of the numbers which in terms of top line and bottom line, which are including these provisions and also excluding these provisions, just to give you an idea of how strong the underlying growth was. So can we put this on? Okay. Only on this one or this one? Oh yeah. Okay, so if you look at net interest income, back. For the full year, of course, is coming at 2,232 crores for the quarter, which comes to 11% growth. But if you add back the 153 crores that we have also removed from this interest income, actually the growth comes to 19%. Fee growth remains, it is not affected by this provisioning, it remains at 29%. And as I said, quarter on quarter, the growth was very strong at 6%. The revenue growth ex IL&FS is 23%, cum IL&FS is 18%. And we go all the way down, so operating profit actually grew by 26% if you exclude the impact, but if you include the impact, it grew by 17%. So we have still double-digit numbers in spite of absorbing the provisioning, both on interest reversal, etc. And if you go down all the way to net profit, the net profit also ex IL&FS is 25%, and of course, cum IL&FS, it comes down to 360 crores for this quarter. But actually, if you interpolate it, it is 1,189 crores, which is actually a 3% growth on quarter as well. You go to the next one. This is for the full year, so we don't need to dwell on these numbers. We can go on. So this is, I think I've already explained to you, the balance sheet growth. Loan growth is, as I said, pretty well spread out. You see an unusual number in terms of the microfinance, but that's because a lot of the lending that other banks did to Bharat Financing has been taken over by us in anticipation of the merger. So that's why you're seeing this large increase in terms of percentages. But that's because after the merger, the only lender to Bharat Finance will be IndusInd Bank. That is by regulatory mandate. A subsidiary cannot have lending from other banks. So in any case, it would be taken over by us. So we are doing that a little bit in advance. And CASA growth I've already talked about. Borrowing growth is around 24%. I think we can move on to, yes. This I'll come back to in terms of this thing. So let me first finish the fee part of it. Fee growth, as I said, was 29%. And we have a breakup of the fee growth to show you how well it is spread out. Because we have heard debates and discussions on how fee is concentrated in one particular part of the bank. But we'll show you how the fee is actually made. So these are the broad 5 or 6 lines in which the fee is made, and all the lines have moved pretty well. But this time we are giving more color to how the fee is made. So if you look at this pie chart, 42% of our fee comes from the corporate bank, 48% of the fee comes from the retail bank, and 10% comes from trading and the treasury income, etc. And if you look at it in a further segmentation, you see how granular the actual fee income is. Okay, so that's there. Let's go back into the quality, the quality of the loan book, etc. I think we can go on there. Yeah. Credit cost also. There has been some speculation on credit cost and the percentage of the stressed book. So we'll show you all that as well. But if you exclude IL&FS, if you see that column, the credit cost for the quarter is 19 basis points. That is your business as usual credit cost. Including IL&FS, it's 108 basis points. And if you go on further for the full year, excluding IL&FS, the credit cost is 57 basis points. Actually, net is 56 basis points, which is well within our stated ambition of keeping it below 60 basis points. So that's one angle of it, which is the credit cost part of it. Yes, that's the other one. So if you look at gross and net NPAs, and if you take out the impact of IL&FS, actually gross NPAs have fallen, ex-IL&FS. Gross NPA is actually down from 1.13 to 1.03%. That's the figure in green. And similarly, net NPA is down from 0.59 to 0.48%. With IL&FS, of course, the number is certainly up, as is reflected here. Then I want to talk about a few other things that are being talked about in the market. So there are these market rumors about, what the stressed book is and what are exposures to a particular media company, a particular diversified company, NBFC, conglomerate, a housing finance company, a company in Calcutta and all that. So I thought we'll place this on record that the banks, if you take all these names that are being bandied around, all these names, right? The bank's funded and non-funded exposure is 1.9% of the loan book, right? So the question here is, we waited for the results to come and talk about this thing, because every time somebody writes a report on this exposure, you don't go running to the exchanges to try to explain this sort of thing. We thought the right time to do it when we disclose our results. So the total exposure to all these names put together is 1.9%. You can call it potential stressed exposure, you can call it watch list, you can call it whatever. That's the total exposure, 1.9%. This is very well secured, not a single day is overdue as we speak today. Right? So they are all standard in our books, I think. We also want to make a little point about how people compute these exposures. So they go to the registrar of companies where all these charges are filed. And I think in the process there's a huge amount of misinterpretation on how they read the filings of these charges. It's completely, in many cases, totally misinterpreted. But I won't go into that. I'll explain that maybe in the investor presentation in more details. This is the other part, which we don't disclose, but we will now disclose annually, which is what is the SMA2 exposure of the bank. And we've given it sector-wise. And if you look at it, at the end of the day, this is one of the lowest SMA2 exposures probably in the industry. The total SMA2 is 641 crores. Actually, this week, it has fallen to 548 crores on a book of 186,000 crores, which is 0.3% of our total book. Right? So this is a slide that we will present, but not every quarter. We will present it at least annually to give you a flavor of what is overdue in our books, on the basis of which there is a lot of speculation. The investment grade book and the sub-investment grade book we disclose every quarter. You see a bulk of our book is investment grade. And of course, on the retail book also we give a color. we give the weighted average risk score, and the best is 1, and most of our book lies between 1 and 2. That's one. That's the other part. I've already talked about the sustainability of the fee income and how granular the fee income is. Apart from this, business as usual, 107 new branches were opened during the quarter, taking our total number of branches to 1665. And we also got 1 million new customers during this quarter. So I think the business continues apace. Most of it is on target. Lastly, before we open ourselves to questions, the outlook as far as the future is concerned. So I think our business as usual profit is what we want to emphasize. That is pretty strong. Q4 business as usual profit was 1189 crores. That's what we start with as of 1st of June. And you can add to that post the merger once it happens. 1st of April. 1st of April, actually, not June. 1st of April. Because June results will be declared also by the 10th of July. We are just 6 weeks ago. And hopefully, when we come to you with the June results, that means in July, we will show you the consolidated results of the two companies, IndusInd Bank and Bharat as well. I think going forward, our loan growth aspirations still remain upwards of 25%. It will be our attempt to match loan growth with deposit growth up to the extent that we can. Cost to income ratio, we have, if you take out the impact of IL&FS, was 43.5%. We expect the cost to income ratio to fall by another 1.5% during this financial year 20.